Swing Trading. Chapter 1, Foundations of Swing Trading. The simplest way to separate trading styles is by holding period, how long the trade stays open from entry to exit. That single choice affects almost everything else, including which charts you use, how often you need to monitor price, and what kind of risk you are accepting. A trade is not just a buy or sell button, it is the full sequence of entry, holding, and exit. If you hold only during the market day, your routine and risk will look very different from someone holding for weeks or months. This is why trading style is really about fit, not status. The best style is usually the one that matches your time, temperament, and ability to follow a process consistently. Day trading means opening and closing the trade within the same market session. The goal is to capture short intraday moves, often over minutes or a few hours, and be completely out before the closing bell. One major advantage is that day traders avoid overnight gap risk, which is the risk of a stock opening far above or below the previous close because of news released after hours. In exchange, this style demands close attention during market hours and quick decision-making. Day traders often rely on very short charts, such as 5-minute or 1-hour timeframes, because they are focused on the fine detail of intraday movement. For some people, that pace is appealing, but it is also mentally demanding and hard to combine with a normal workday. Swing trading sits in the middle. Instead of trying to catch a move inside one trading session, swing traders aim to capture price movement that unfolds over several days or sometimes a few weeks. That usually means using the daily chart as the main decision tool, while the weekly chart gives broader context. This approach often fits people who cannot sit in front of screens all day but can review markets at set times. The trade-off is that swing traders accept overnight risk, including gaps caused by earnings, news, or changes in market sentiment. Even so, many traders prefer this style because it offers a balance between opportunity, flexibility, and a manageable routine. Position trading stretches the holding period much further and focuses on the bigger trend. A position trader is less interested in the normal back and forth of a few days and more interested in whether the asset is generally rising or falling over months. Because of that, weekly and monthly charts become more useful than short-term charts. This style requires patience, because even strong long-term trends often include uncomfortable pullbacks along the way. It also requires tolerance for larger drawdowns, since a position trader may sit through declines that would feel unacceptable to a swing trader. The reward, if the trend holds, is the chance to participate in a much larger move. When you compare the three styles side by side, the differences become practical very quickly. Day trading asks for the most screen time and the fastest reactions because trades are measured in minutes or hours. Swing trading usually needs a brief but regular review process, since trades last days to weeks and decisions are often based on daily charts. Position trading is slower still, with less frequent oversight but more patience during pullbacks. In general, the longer the holding period, the less constant screen time you need. That is why choosing a style based on your real life matters more than choosing the one that looks the most exciting. Your schedule is one of the best filters for choosing a trading style. If you are free to watch markets throughout the day and make rapid decisions, day trading may be realistic. If you can check charts once or twice a day and prefer a more structured routine, swing trading is often a better fit. If you want an even slower pace and are comfortable holding through bigger swings, position trading may suit you better. The important point is to be honest about your actual availability, not your ideal version of it. A style that fits your schedule creates less pressure, and less pressure usually leads to better discipline. The time frame of your chart should match the kind of trade you are trying to manage. A day trade belongs on intraday charts, a swing trade usually begins on the daily chart, and a position trade depends more on weekly or monthly structure. Problems often start when traders enter from one time frame but react emotionally to another. For example, someone may plan a swing trade from the daily chart, then stare at every 5-minute fluctuation and exit too early. The shorter chart makes normal noise look dangerous even when the bigger setup is still valid. Matching the chart to the trade helps your decisions stay consistent with the original plan. Every trading style avoids some risks and accepts others. Day traders avoid overnight gaps, but they deal with more intraday noise, more speed pressure, and more frequent decision-making. Swing traders accept overnight news risk and often need wider stops because they hold through multiple sessions. Position traders may face even larger drawdowns and much longer periods of uncertainty. So there is no perfect style that removes risk altogether. The goal is not to eliminate risk, but to choose the kind of risk you understand and can manage well. One important idea for beginners is that the same stock can be traded in completely different ways. A day trader might hold it from 10 o'clock to 11 o'clock to catch a small intraday move. A swing trader might hold that same stock for 3 days, aiming for a larger move on the daily chart. A position trader might own it for 6 months because the long-term trend remains strong. The asset has not changed, but the goal, the chart, and the trade management have all changed. This is a useful reminder that style is defined less by what you trade and more by how you trade it. Most early mistakes come from mixing styles without realizing it. A trader may enter from a daily chart, panic on a 5-minute chart, and accidentally turn a reasonable setup into an emotional decision. Another common mistake is treating day trading like easy money, when in reality it requires speed, focus, and a lot of practice. Swing traders also get into trouble when they fail to exit and let a short-term trade drift into an unintended position trade. And because swing trades stay open overnight, ignoring gap risk can be costly. The safest habit is to decide the style, time frame, and risk before the trade begins, then manage the trade according to that plan. Once you understand what swing trading is, the next question is which charts best support it. Because swing trades usually last several days to a few weeks, you want enough detail to plan the trade without getting pulled into meaningless noise. Very short time frames often show every small wiggle, and that can make normal movement feel urgent. Daily and weekly charts create a much better balance. The weekly chart helps you step back and see the broader direction, while the daily chart gives enough structure to plan entries and exits. Together, they keep your analysis aligned with the actual holding period of a swing trade. The weekly and daily charts work best when they do different jobs. A weekly chart compresses one full week of trading into each bar, so it is useful for identifying the bigger trend and overall market character. A daily chart shows one bar per trading day, which gives you more detail for timing the setup. In practice, many swing traders start with the weekly chart to form a directional bias, then move to the daily chart to decide whether the current price action supports that view. This simple sequence reduces confusion. Instead of asking one chart to answer everything, you let each time frame do the work it is best at. Sure, time frames are not wrong, but they often hurt swing traders when used at the wrong stage. Intraday charts contain much more noise, so small reversals can look more important than they really are. That can trigger rushed exits, early stop changes, or the feeling that you must constantly react. Meanwhile, the daily chart may still show a normal pullback inside a healthy trend. This is why a trader can be correct on the bigger move but still lose money through poor execution. Often the real problem is not the setup itself, but the mismatch between the trade duration and the chart being watched. The daily chart is especially useful because it filters out much of the back and forth that distracts newer traders. On this time frame, it becomes easier to see whether price is generally trending up, trending down, or moving sideways. You can also identify pullbacks within that trend, which is often where swing opportunities appear. Support and resistance levels tend to stand out more clearly on the daily chart than on very short charts. And when price reaches one of those areas, you can watch for signs that momentum may return in the trend's direction. In other words, the daily chart helps turn raw movement into something more readable and tradable. A practical routine is to begin with the weekly chart as a trend filter. Look back roughly 3 to 6 months and ask a simple question. Is this stock in an uptrend, a downtrend, or a range? At this stage, you are not trying to pick an exact entry or predict tomorrow's candle. You are only trying to classify the broader direction. That broad view helps you avoid taking daily setups that fight the larger trend without good reason. It also helps to write the bias down in plain language, such as bullish, bearish, or neutral. That small habit can make your later decisions more structured. After the weekly direction is clear, the daily chart becomes the tool for setup and timing. If the weekly chart is in an uptrend, the daily chart can help you look for pullbacks rather than chasing strength. If the weekly chart is in a downtrend, the daily chart can help you spot rallies into resistance rather than selling after a sharp drop. And if the weekly chart shows a range, you usually want to be more selective because the larger trend is less supportive. This step is really about location. A good swing trade is not just about direction, but about entering from a place where risk is defined and the setup makes sense. The daily chart should offer evidence that the larger trend may be resuming. In an uptrend, that evidence might look like a pullback toward a 20-period moving average, a pause after the pullback, or a bounce from prior support. In a downtrend, the same idea applies in reverse, with rallies into resistance followed by weakness. The key is that you are waiting for continuation, not guessing blindly. A moving average can be a useful reference point, but it is not a guarantee on its own. What matters is whether price behavior begins to support the weekly trend again. A strong swing plan aligns entry, target, and stop across the two timeframes. For a long trade, a weekly uptrend may suggest that upside opportunity exists, while the daily chart gives a better location for entry during a pullback. Weekly levels can help set realistic targets because they reflect the bigger structure of the chart. Daily swing lows or highs often help with stop placement because they define where the shorter-term setup would likely be invalidated. The same logic works for shorts, with a weekly downtrend and a daily rally into weakness. When both timeframes support the trade, the plan tends to feel clearer and less forced. A simple example makes the process concrete. Suppose the weekly chart of a stock called ABC shows a clear uptrend, so your bias is bullish. On the daily chart, price pulls back from $50 to $47, where it begins to stabilize near support and around the 20-day average. That is much more useful than buying after a sharp run higher, because the trade now has structure. A possible plan might be to enter around 47.50, place a stop below the recent swing low near 45.80, and use a higher weekly level around 53 as the target. The exact numbers matter less than the logic behind them. Trend first, setup second, risk clearly defined. Most mistakes with timeframes come from losing the connection between the weekly chart and the daily chart. Traders often buy against the weekly trend because the daily move looks exciting in the moment. Others drop into intraday charts for swing entries and end up reacting to noise instead of structure. Ignoring daily support and resistance can also lead to poor entries, especially when price is already extended. Stops that are too tight get hit by normal movement, and jumping across too many timeframes creates confusion rather than clarity. In most cases, keeping the process simple with just weekly plus daily charts leads to steadier decisions. The best way to learn this is to practice it on a stock you do not own. Start with about 4 months of weekly data and label the chart as an uptrend, downtrend, or range. Then switch to the daily chart and study the last 5 trading days. Ask yourself whether the recent daily action supports the weekly direction or conflicts with it. Try to summarize that answer in one clear sentence. This exercise trains pattern recognition and keeps you focused on alignment instead of prediction. Technical analysis matters, but in swing trading mindset often matters just as much. Because trades can last days or weeks, price rarely moves in a straight line from entry to target. Even a good trade may dip first, and a weak trade may briefly look strong before failing. That creates emotional pressure, especially when money is at risk and the chart is moving against your comfort level. Many traders do decent analysis and still underperform because they react badly to normal movement. The real challenge is learning how to stay with the plan when the market becomes uncomfortable. A strong trading mindset usually rests on 3 traits: patience, discipline, and emotional control. Patience helps you wait for quality setups instead of forcing trades out of boredom or urgency. Discipline helps you follow the written plan once the trade is active, including entries, stops, and exits. Emotional control helps you notice fear, greed, or frustration without letting those feelings take over the decision. These 3 traits work together rather than separately. When they are in place, risk management becomes more consistent and trading becomes less impulsive. Patience is often misunderstood as doing nothing, but in trading it is an active skill. It means waiting for conditions that actually match your rules, rather than taking a trade because you feel the need to be involved. It also means giving a valid trade enough time to develop instead of demanding instant results. One of the strongest choices a trader can make is to stay in cash when the setup is unclear. That is not missed opportunity, it is selective decision making. Good patience protects capital before the trade and supports calm management after the trade begins. Discipline is what turns a plan into actual behavior. It means entering only when your criteria are met, using the planned stop loss every time, and respecting profit targets or exit rules in advance. The hard part is that emotion often pushes in the opposite direction. Fear can make you hesitate or exit too soon, while hope can tempt you to move a stop or ignore an invalid setup. Discipline creates repeatability, and repeatability is what allows you to evaluate whether a method truly works. Without discipline, even a good strategy becomes impossible to measure or trust. Emotional control does not mean becoming numb or robotic. It means recognizing emotional triggers early enough to create a pause before acting on them. FOMO can pull you into chasing a move that is already extended. Fear can make you exit on a normal pullback even though the setup is still valid. Greed can keep you in a trade after your planned target, and revenge trading can push you to force a new trade after a loss. These reactions are common because losses feel personal and urgency feels persuasive. The skill is not avoiding emotion completely, but refusing to let it make the final decision. One helpful way to stay calm is to build a short routine around moments of pressure. Before the trade is active, define the entry, stop, target, and position size so the important decisions are already made. If the market makes a sharp move, pause for a full minute rather than reacting immediately. Then, ask a simple question. Is the original plan still valid, or has something objectively changed? If the answer is yes, your job is to follow the plan, not your feeling. This kind of structure does not remove emotion, but it stops emotion from taking over the process. Stressful moments are easier to handle when the response is prepared in advance. If you feel FOMO because price is running without you, the response is not to chase but to wait for the next proper setup. If price hits your stop, the response is to exit as planned rather than negotiate with the market. If you feel tempted to widen the stop, that is usually hope speaking, and hope is a poor risk tool. After a loss, stepping away for a while can prevent the impulse to trade emotionally. Prepared responses reduce the number of decisions you have to invent under pressure. Consider a simple example. Olivia planned to break out above $52, set her stop at $48.50, and chose a target at $56 before entering. She bought 90 shares at $52.01, and shortly after, the stock pulled back to $51. That drop created anxiety, but it did not break the trade plan. Her stop was still intact, her risk was still defined, and there was no objective reason to exit early. By checking the plan instead of reacting to fear, she stayed in the trade long enough for the stock to later reach her target. Most mindset mistakes share the same root problem: replacing a plan with a feeling. Traders often confuse action with progress, as if doing something always means improving the trade. They may use stops that are too tight because they fear loss, or add risk to a losing position because they want to be right. Some jump back into the market too quickly after a loss just to repair their confidence. These habits feel active, but they usually weaken results. The core lesson is simple. Calm, consistent execution matters more than emotional intensity. Price swings do not happen in a vacuum. They often reflect different groups entering the market with different goals, different time horizons, and different levels of urgency. For swing traders, that matters because the character of a move can hint at whether it is likely to continue or fade. Some moves are orderly and persistent, while others are fast, emotional, and unstable. When you learn to ask who may be behind a move, the chart starts to tell a richer story. You will never know with certainty every time, but understanding the likely driver can improve timing and expectations. 4 groups are especially useful to keep in mind: institutional investors, retail traders, market makers, and insiders. Institutions often move large amounts of capital and can create sustained trends over several days or weeks. Retail traders usually act in smaller size, but together they can amplify momentum, especially around headlines or social media attention. Market makers do not usually create major trends, but they influence short-term price movement by providing liquidity and adjusting quotes. Insiders add another layer of context because their reported trades can shape sentiment. Thinking in terms of these groups helps turn price action from random noise into something more interpretable. Institutional investors often create the kind of swings that are most attractive to swing traders. Because they trade in such large size, they usually cannot buy or sell everything at once without disrupting price too much. Instead, they tend to accumulate or distribute in stages over multiple sessions. That process can create smoother multi-day trends with orderly pullbacks and solid volume. Those are often healthier conditions than a single dramatic spike. When you see steady price progress backed by consistent participation, it can be a clue that larger professional money is involved. Retail traders usually do not move a stock by themselves, but large numbers of them acting together can add speed and emotion to a move. Attention from social media, breaking news, or a sharp momentum burst can pull many small traders into the same name at once. That can push a rally higher very quickly, or create sudden selling when fear takes over. The challenge is that these moves often happen faster than they stabilize. A one-day spike may look exciting, but it is not always durable. For swing traders, strong movement is not enough. The quality of the movement matters too. Market makers play a different role from institutions or retail traders. Their job is to help keep trading active by standing ready to buy and sell, which helps match order flow between buyers and sellers. They usually earn money through the bid-ask spread rather than by building large directional positions. For swing traders, their influence shows up more in execution cost than in trend creation. In calm, liquid conditions, spreads tend to stay tighter and entries are easier to manage. In volatile moments, spreads can widen, and that makes getting in or out more expensive. Insiders include executives, directors, and major shareholders who know the business closely. Their legal trades are reported, which means outside traders can review them later as part of the broader picture. Insider buying is often easier to read because it can signal confidence in the company's prospects. Insider selling is harder to interpret, since people sell for many reasons that are not necessarily bearish. For swing traders, insider activity is usually not a direct trading signal by itself. It works better as background context that can either support a chart move or make you question it. Many swings develop in recognizable stages as different groups take turns influencing price. Often the process begins quietly, with institutions building positions over several sessions. As the chart improves, retail traders begin to notice and join, which can increase momentum and attention. Eventually, the larger buying may slow down, and the move can become more dependent on late arrivals. If those late buyers panic when price weakens, the reversal can accelerate quickly. Market makers then adjust prices and spreads around the changing order flow, shaping how that transition feels in real time. Imagine a stock rising from 50 to 55 over 5 days in a steady, controlled way. Higher closes, shallow pullbacks, and firm volume might suggest that a large buyer is accumulating shares gradually. A swing trader entering near 52 is participating in that steady demand, not in a late emotional burst. Then, retail attention arrives and pushes the stock quickly to 58. If the original institutional buying is already finished, that late surge may have weaker support underneath it. In that case, selling into strength can be wiser than holding and hoping the crowd-driven move keeps going. You will never know for sure who is in control of every move, but the chart often offers clues. Orderly moves that develop over 5 to 10 days with steady volume and manageable pullbacks may suggest institutional activity. Sharp 1 or 2 day spikes after attention surges often look more retail-driven. Volume matters too, but the pattern of volume matters more than one dramatic burst. Consistent participation over time is usually more meaningful than a single explosion. Insider filings can add useful background, but the main evidence still comes from pace, pullbacks, volume, and what happens after the crowd notices. A lot of poor swing decisions come from misreading the dominant participant. Chasing an emotional spike can lead to buying at the point of greatest excitement and weakest support. Assuming quoted prices are always stable can also be a mistake, especially when spreads widen in fast conditions. Traders often treat all volume as bullish or bearish, even though accumulation volume and panic volume can mean very different things. Another common error is reading too much into insider selling without considering other explanations. Better decisions usually come from combining price action with volume, trend, news, and overall market conditions. A good practice exercise is to study one actively traded stock over the last 3 months and try to connect its behavior to likely participants. Look for steady 5 to 10 day advances or declines, and then mark any sudden 1 to 2 day spikes. Compare the pace, pullbacks, and volume during those different periods. If possible, check whether any insider filings appeared around the same time. Then write a simple conclusion about which group seemed most influential during each phase. The goal is not perfect certainty. It is better pattern recognition and better context reading. After learning how swing trades are analyzed, it helps to build a workspace that supports that process. Your setup should make decisions calmer and clearer, not louder or more complicated. Swing trading is not about staring at every tick all day, so your workspace should be designed for planned review, screening, and trade management. Reliable tools matter more than flashy tools. Clear charts, a usable watch list, and a practical routine are far more valuable than a wall of distracting information. Think of your workspace as a command center for disciplined decision-making, not constant stimulation. Most beginners need only a small set of essential tools. Start with a reliable computer and a stable internet connection, because both matter more than people often realize. You also need a trading platform for placing orders, a charting platform for analysis, and a stock screener for finding candidates. In many cases, one platform can cover more than one of these jobs, which is perfectly fine. The key is not to assemble the biggest tool collection. The key is to have a simple setup that works consistently and does not get in your way. When choosing software, focus on the tasks swing traders actually use most often. You want daily and weekly charts available without friction, because those are usually the core analysis timeframes. It also helps to have a few common indicators, the ability to run stock screens, and a clean way to set price alerts. Watch lists and current positions should also be easy to view at a glance. None of this needs to be advanced or expensive at the start. Beginner-friendly software is often just software that covers the basics well and presents them clearly. Your chart setup should stay simple enough that the important information stands out quickly. For most swing traders, that means keeping both a daily chart and a weekly chart available for every stock being reviewed. Adding the 50-day and 200-day moving averages can help with trend context, and RSI can offer a basic read on momentum. These tools are not there to predict the future. They are there to help you organize what price is already showing. If the chart becomes crowded with too many indicators, decision quality often gets worse, not better. A screener helps solve a practical problem. There are simply too many stocks to review one by one. By using a few sensible filters, you can narrow the market into a manageable watch list. For example, a beginner might look for stocks priced between $5 and $50, with average volume above 500,000 shares, and a pullback toward the 50-day moving average. You can also focus the screen on names whose daily and weekly charts are worth checking more closely. These filters are not universal rules. They are starting points that help you spend attention where it is most useful. Good screen organization reduces friction and saves mental energy. Ideally, you want the daily chart visible, the weekly chart visible, and your order entry area easy to reach without hunting through tabs. Your watch list and screener should also stay accessible so the workflow feels smooth. This does not require a large multi-monitor setup. One monitor can work very well if the layout is clean and the windows are arranged with purpose. What matters is not how impressive the desk looks, but how easily you can move from analysis to action without confusion. Alerts are one of the most useful tools for swing traders because they reduce the need for constant monitoring. Instead of watching price every minute, you can set alerts at the levels that matter. An entry price, a stop loss, a profit target, or a key moving average. Then the market tells you when attention is needed. This supports a calmer routine and helps you avoid over-managing trades that are not actually at decision points. Alerts do not replace analysis, but they do make your process more efficient. They are especially valuable if you have a job or other responsibilities during market hours. A repeatable daily routine is often more important than the tools themselves. Before the market opens, you might run screens, review open positions, and check for overnight gaps or news that changed the picture. During the day, swing traders usually do best with planned check-in times rather than constant watching. After the close, you can mark important price levels, lob trades, and prepare for the next session. This kind of routine reduces emotional decision-making because it gives your attention structure. Over time, a calm routine often becomes one of your strongest trading tools. A simple example shows how effective a basic setup can be. Maya uses a single 24-inch monitor and keeps her process focused rather than elaborate. She reviews daily and weekly charts, keeps a 50-day moving average and RSI on both, and runs a screener for stocks between $10 and $50 with volume above 500,000. A stock such as AZ appears at $22.50, and she builds a plan around it instead of reacting impulsively. She sets alerts for the entry, stop, and target, then checks the market at scheduled times. The lesson is that a useful workspace does not need to be expensive. It needs to support good decisions. Most workspace mistakes come from overcomplication or weak habits. A screen that is too small can hide detail and make chart reading harder than it needs to be. Skipping alerts often leads to missed opportunities or rushed responses. Overloading charts with indicators creates conflicting signals and unnecessary noise. Ignoring post-market reviews slows learning because mistakes never get examined properly. And while a phone can help with alerts, using it as your main trading platform usually reduces context and precision. A simple setup with strong habits is almost always better than a complicated setup with poor discipline. By this point, the main ideas of swing trading are in place, so it is useful to look at where beginners often go wrong. Swing trading gives you more time to think than day trading, but that advantage disappears when decisions become rushed or emotional. New traders often chase fast-moving stocks, hold losers while hoping, take trades outside their method, ignore the broader market, or change the plan under pressure. None of these mistakes requires bad intelligence. They usually come from poor process and emotional discomfort. Understanding the common traps makes it easier to build habits that avoid them. A strong start in trading comes from thinking in process rather than prediction. Each trade is only one outcome, not a final judgment on your skill. Controlled losses are part of the business and they are manageable when risk is defined properly. Just as important, a winning trade does not automatically prove that the process behind it was good. A reckless trade can make money once, just as a good trade can lose once. What matters over time is consistency, not excitement, and repeatability, not the feeling of being right. One of the best beginner habits is to define risk before entry. Before you buy anything, you should know where you plan to enter, where you will exit if you are wrong, and how much money you are willing to lose on the trade. That means risk comes before reward in the planning sequence. For example, if your account is $10,000 and you risk 1% per trade, your maximum loss is $100. If your entry is 50 and your stop is 48, you are risking $2 per share, which means a position size of 50 shares. Thinking this way keeps losses small and turns trading into a structured decision rather than a guess. Chasing is one of the most common beginner mistakes because fast price movement creates a strong sense of urgency. A stock that has already surged can feel like an opportunity that will disappear if you do not act immediately. But late entries usually come with weaker risk control because support is farther away and pullback risk is higher. Very often, a better choice is to wait for a planned entry area, such as a pullback towards support. And sometimes the best trade is no trade at all. Passing on a bad entry is not failure. It is part of protecting capital. Beginners also tend to focus on the individual stock and forget the broader market context. Even a strong chart can struggle if the major indexes are weak and selling pressure is broad. That is why it helps to check a major index first, using the daily chart to understand the overall environment. If the market is healthy, long setups often have better support. If the market is weak, you may need to be more selective or simply trade less. Market alignment does not guarantee success, but it can improve the odds and keep you out of avoidable trouble. A trading journal is one of the simplest tools for improving without guessing. Memory is selective, especially after emotional trades, so writing things down turns impressions into evidence. A useful journal records the entry and exit, the profit or loss, the reason for taking the trade, and whether the plan was followed. When you review that journal weekly, patterns start to appear. You may notice that you often chase extended stocks, ignore stops, or trade poorly after losses. Those patterns are much easier to fix once they are visible. A simple risk example makes the importance of planning very clear. Suppose you have a $5,000 account and decide to risk 1% on a trade, which is $50. If you plan to enter at 45 with a stop at 43, your risk per share is $2. Dividing $50 by 2 gives you a position size of 25 shares. If the stop is hit, the loss is limited to $50, which is unpleasant but manageable. Compare that with an emotional, oversized trade where the position is too large and a normal move against you causes real damage to the account. Most beginner mistakes can be reduced by pairing each bad habit with a better one. Overtrading improves when you wait only for clear setups. Holding losers improves when you respect the stop loss without negotiation. Chasing improves when you wait for a better entry instead of acting on urgency. Ignoring the market improves when you check the major indexes daily. Risking too much improves when position size is based on planned dollar risk rather than excitement or confidence. These are simple rules, but simple applied consistently is often what creates survival and progress. A good bridge between learning and real trading is paper planning. Choose a stock you are watching and write out the entry, stop, and dollar risk before any money is involved. Using 1% of your account as a guide can help keep the exercise realistic. Also, write a short note about why the setup interests you and one sentence about the market trend. This forces you to think in complete trade plans instead of vague opinions. Practicing that process repeatedly builds discipline before live pressure is added. The real goal in swing trading is not to avoid every losing trade. Losses are part of the business, and no method removes them completely. The real goal is to avoid unnecessary losses caused by poor habits, oversized risk, and emotional decisions. That means acting from a written plan, waiting for quality setups, respecting market conditions, and keeping losses small enough to survive. Improvement comes through review and repetition, not through forcing results. If you can reduce avoidable mistakes, you give yourself a real chance to improve over time.